freedom isn't the result of wealth, it's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey. I'm here with Adam Penn. Adam, how are you today?
I'm doing great, Dustin. I'm excited for the weekend. It's the rodeo here in Red Bluff.
Nice. I've never been to a rodeo.
I know you said that earlier this week when we were meeting. It was kind of surprising, aren't you?
Yeah, everyone looked at me like, "How's that? How's that even
Tennessee.
possible?" But it's like a Western thing, though. We don't. I mean, I guess we have them around here, but we don't like that's. It's not a big, but it is a big deal, right? Like this rodeo out there's it's big. How many? 3 days?
It's a 3-day rodeo.
Okay,
Yep.
Which apparently is a thing, right? There's like different categories and classes of rodeos.
I think there's. I mean, I heard on the radio, and this is what we were talking about the other day, was that it says it's the largest 3-day rodeo in the country. And I was like, I feel like they very specifically said 3-day because there's like way larger rodeos. I mean, the rodeo in Vegas is like a 7-day, and it's massive. But here it's still good. I mean, the town is... Red Bluff, I think, is a 7,000 person town, and I think they get like 50 or 60,000 people that come through for this. Jeez. And it's like $2 million of revenue that come into the town. Like most of the town's revenue comes from this weekend.
That's crazy. And how far away from Chico is it?
45 minutes.
Okay. So is like Chico the nearest major town?
It's between Chico and Redding.
Okay. Well, so it's the biggest 3-day rodeo between Chico and Redding. That's the...
Yep. 675 competitors, 35,000 people, and I think they give away $350,000 in prizes.
Okay. No, one of these days I'll have to make it out there and go to it.
It'll be fun.
Does it start tonight?
Yep, starts tonight, goes through Sunday. Then there's another one in a few weeks up in Redding.
Okay.
There's a handful of rodeos around here. Reno rodeo is fun.
Well, speaking of rodeos, I think that's a really good lead into our topic for today.
How?
Infinite returns.
How?
I don't know. It's a good lead. Rodeo is a good lead into anything, right? Come on. I mean.
Okay. Infinite returns.
Infinite returns. What does that mean?
You want me to take this one?
I don't know. You want to? We were kicking around this idea, and I guess I'll sort of tee up the why for this, why we're talking about this. I think it's a concept in some recent calls I've had with investors that have it's come up because it's really kind of core to the way that we like our investment philosophy, the way that we like to do, especially real estate deals. And I guess I take it for granted that we kind of run in circles where this is talked about a lot, and we all just kind of understand what it is. And I start sharing it with other folks, and I'm like, okay, this is not that widely known, and especially if you've only ever invested in stocks, you're like, wait, how's this possible? Like the whole concept doesn't even register. So I think it's a good thing. We've definitely referenced it on this show, and we've talked about stuff in the past, and that we try to hit deals where we can get the infinite return model, but we've never really like
dove into what it is.
Yeah, exactly.
And there's I think there's benefits to it, and then there's some, I don't want to say drawbacks, but there's some things to consider. And an investor friend of ours, business partner, has been doing this for 50 years, and he brought some interesting points to me recently that maybe we'll bring up. That once you do hit that kind of infinite return, which is essentially the simple way of explaining it is you buy a property. We've talked about it, I think, on one of the properties I own before, but you buy a property, $100,000, $20,000 down. Let's just say it appreciates. Now it's worth $150,000. You do a cash out refinance, get a new loan for $110,000. Well, now your loan's $110,000, right? So the bank gave you back $30,000. The $20,000 you put down plus the $10,000 more of the higher loan amount. Now you have all your money back and some. So whatever return you're making, let's just say someone pays you $1 a month, right? That's your positive cash flow. That's over $0 in basis. So it's infinite, right? It's a divide by zero error. And so that's really interesting, right? Because now you've got all your money back and you can go deploy it into something else. And theoretically, if you do that multiple times, and that's really how I built most of my initial portfolio. We were in a market where it worked, and we were able to just buy, fix it up, refinance it, buy something else. And it allowed us to really grow that portfolio. I mean, for a while there, it just seemed unstoppable, right? Then interest rates took off and all those things. So then the market changes and you got to adjust your strategy. But that's the high level.
One thing I want to point out that I think you kind of glossed over that's maybe the most important point. Again, that we take this for granted. You mentioned you get all your money back and you go deploy that somewhere else. You still own the asset.
Mm-hmm.
That's the key thing here is that so yes, you might have a higher loan on it now. So maybe your cash flow on that might have decreased a little bit because your mortgage payment went up, but you still own the asset. So you're still getting the benefits of any continuing equity appreciation plus
Tax
real
benefit.
estate, especially rental real estate. You got inflation adjusted cash flow. That's just especially if you've got fixed rate debt, that mortgage payment is going to be fixed while the cash flow is still going to continue to increase, and that cash flow is just going to continue over time. All while that same original amount of money you've gone and deployed into maybe 2 or 3 other deals that are doing exactly the same thing.
And
so over time, go ahead.
You didn't have to recapture any of the depreciation or any of that on a sale.
Exactly. And so it's a really powerful tool for being able to take like just a single pile of money and go deploy that in multiple places. And then of course that just assumes you're not getting, cash from a job or from other investments or something else that's adding to that you can continue to deploy. And so this is something that can start out kind of small, but over time, like it really snowballs and you can really start to build up a very sizable portfolio of assets that your basis is zero. There's none of your original investment is still left in that deal, and yet you're still getting all the benefits that come from owning it. And you can continue to, as it goes up in value, continue to refi and pull some of that equity off of it. If it's something we've been seeing a lot of this, especially where guys have been sitting on certain buildings for 15, 20, 25 years. They're like, okay, this is getting old. I don't want to own this type of building anymore. We've already refied it 3 times. I'm just going to sell it because I want to go take the equity that's in that and deploy it into something newer. So that's, on a long enough time horizon, that ultimately ends up becoming an option as well. But that's in a nutshell, that's the infinite return model. And so it requires a little bit of a longer term view. This is not, you're not typically flipping properties with this, right? Like the whole double your money in 5 years. This is not that, because the assumption there is you do something and then you sell the asset and you don't own the asset anymore. And so that's a slightly different model.
I think this is almost the more you just get your money back, right? Like I'd love a deal where you can buy it and let's say 6 to 12 months later, you can refinance it and get all your capital back. I mean, that was that 2017 to 2021 time period.
Yep.
You could buy something, interest rates were falling. So not only you said, oh, maybe your mortgage payment goes up. That wasn't normally the case, right?
That's true. Yeah.
In that environment, our mortgage payments went down normally. A debt service went down on all the properties. I mean, I was talking to someone the other day. They refinanced a huge multifamily building. It was like they paid $20 million. It went up to $40 million. They had put like $4 million down. So it's $16 million loan. They got a new $30 million loan at a lower interest rate and interest only. So they got $14 million of cash out from their initial $4 million they put down plus an additional 10. And their payment went down. So their cash flow on the building went up. They make more every month.
Yeah.
They got $14 million in their pocket tax-free, and they went and bought another building that then makes, I think they bought a $50 million building with it.
It's incredible. And that's this really gets to the core of why we and a lot of other people love real estate. There's very few other types of assets that you can do this, and what really enables it is the favorable debt. Right? Like you can't really do this with stocks. You can't do this with your brokerage account. I mean, you can use leverage, but get a margin account. But even then, like you're still subject to margin calls. And there's some other things there. It's not. This is just really unique. Like you can't really do this anywhere else where you can get all of your original money back, go deploy it somewhere else, and yet you still own 100% of your original ownership in that asset. And it's incredibly unique and incredibly powerful.
One of the things that they brought up to me that similar investor had brought up something I had never heard of before, which was mortgage over basis. And that was that initial building. Let's go with that same example, right? You spent $20 million on a building. You it's now worth 40, and you cash out, refinance it, now you have a $30 million loan. Your basis in that property is 20.
Yeah.
So if you go and sell it at any point with this new $30 million loan on it, your gains, you're only going to get $10 million of cash if you sold it at 40, right? Because you're going to get the 10 between the 40 and the 30. But you're going to pay gains on that other 10 million because your initial basis was 20.
Yeah.
So if you only have $10 million and you're looking to go redeploy that, you could have an issue there, right? And that's not necessarily a problem. You can 1031 it, right? But once again, if you only have $10 million there of equity, because you've already taken that other 10 million, deployed it into another asset, that 10 million might not be enough to go buy another asset that needs to be at least $40 million and then have any type of basis in this new property.
No, you're spot on. So you mentioned, I think we've done a good job of talking about the benefits of this and kind of like why we like it. But there are some drawbacks. And Adam, I don't know if you've got a handful that are top of mind. I can think of a few.
No, I had that one. I mean, I probably can come up with something else. I will say really quick, if anyone's liking this episode, and likes the content that we put out, please like, subscribe, hit the thumbs up button. All those things are annoying. You've heard it 10,000 times, but it actually tricks the AI computers into not attacking you when they turn sentient. So definitely helps.
This is true. I'm glad you mentioned that. And we appreciate everyone tuning in here for actionable IT advice. Mm-hmm. But yes, please do, leave if you're on Apple or, I don't know, I use Apple. Adam, on Spotify, can you leave reviews and stuff?
Leave reviews.
No. Okay.
Just it.
So if you're on Apple Podcasts, leave a review. Go in there, give us 5 stars. We'd very appreciate it. Leave, hopefully say something nice about us. But that to Adam's point, it helps the algorithms know that you're enjoying what we're doing here and start exposing these ideas to more people. We very much appreciate it. But yeah, I think the other downside, and I think that this is especially for when we try to do this with the syndication model, and this is not just like our own money in an individual deal or something, because this works on any kind of scale, right? You can do this on a single family home, you can do this on a $100 million apartment building. The idea works at
the
any
principle's
scale.
The same.
Yeah. The biggest downside is the whole time. If you don't have that long-term vision and you are looking for that double your money in 5 years, there's this misalignment between what you're wanting to do investment-wise and what this actually does. And so it's just yet again another flavor, another nuance where you've kind of got to be very aligned on what you're looking for your investments, your investment timeline, your liquidity preferences. Because again, one of the beauties of this is you eventually do get all your money back, but it's on a slightly longer time frame. But we think generally we like and take the view that the benefits of waiting a little bit longer to get it back are worth it over the extra long term, because you don't end up losing any of that ownership and you can continue to get the cash flow and extract more equity in the future. But there's definitely that timeline and time horizon consideration to where you definitely have, if you like the idea of this, you kind of have to be in it for the long haul and be willing to say, okay, we're playing the long game here. But that's really where the benefits stack. We've talked about compounding before. This is yet another thing that compounds, where when you start doing this over one deal, that's great. But when you've now got multiple sets of money that you're putting out in places and getting it back and redeploying it, like I said earlier, it really starts to snowball very, very fast. But it does take a little bit of time, and you've got to have that initial patience to kind of get it going.
I heard someone the other day describe it, and I think it matches what I'm doing a lot, or what kind of our mindset is they were market buyers and opportunistic sellers. So when they would buy things at market rate. I mean, there was no off-market crazy deal that led to wealth. They just bought market deals that they saw upside in. His example was if you walked into the office and the guy who's owning the apartment building is the owner, he's managing it, and he's never heard of a computer. That's the perfect idea, right? Yeah. He's like, there's no way their rents are at market. You've got tons of time, or you've got tons of upside. But those, they're just market deals, right? There are plenty of them out there. And then the second one is they were opportunistic sellers. So when someone came in and made an offer, even if they didn't want to sell it, if they looked at what their return on equity was based off of that offer, right? If they were making, let's just say based off of the equity they had in the property, the money they put in, 10% cash on cash returns on the equity, right? The amount of money they have in there. Well, that's one thing. But what if the offer has so much more equity that it's really a 4% return that they're making based off of the new offer of what someone else is willing to pay for that building? Well, they could buy 6 cap deals all day long. So let's sell this at the 4 cap this person's willing to pay. Yep. And now we're going to go redeploy that into something else, right? They weren't forced to do it, but when the deal made sense, it's something they do.
And I think that describes a lot of folks who had bought stuff in the mid-2010s, and then kind of what happened in the early 2020s. You saw a lot of opportunistic selling, taking the stuff that they had intended to hold for a long time, but the market kind of hands you a gift. It's hard to say no. But I think the important thing, and this is a little off topic from infinite returns, but if you think about selling something, it really shouldn't be, okay, I'm selling this because I need the cash. It's like, I'm selling this because I'm now going to take this and deploy either into an asset of equal size or ideally of greater. And we've certainly seen a lot of that. And again, that's the benefit of being in real estate is so much of it's leveraged. And so if you have had some of these properties that have appreciated over time, maybe the better play is to sell, pull all the equity back out, and then use that to get into something significantly larger, a much larger property size than what you previously had. So that, there's definitely a situation there where that, either opportunistic or seeing a situation and saying, okay, we've got enough here, we're ready to kind of bump up to the next level. The selling makes sense, but it's not selling to sell and just give everybody cash. It's selling with a very specific intention of redeploying into something else and continuing the snowball just on a larger level.
Anything else on this topic that you want to cover, Dustin?
I don't know. I mean, this is, again, I guess we kind of take for granted that we sort of grasp this. I think it's something, if you've never really been exposed to it, it can kind of be a little bit of a change if you're used to, okay, well, in order for me to get access to my equity, I have to sell. And that's just not the case in real estate. You can get all of your original equity back and still keep the ownership. So no, I don't know that I got a lot else here. We can keep this kind of a shorter episode, but important concept. This will be a good, I guess, piece of content we can refer people to in the future for, like, hey, if you got more questions, come check out this episode. So if you've ended up at this episode because we pointed you here at some point in time in the future, welcome back to the past. We're glad to have you. It's again, to Adam's point, I think we take the view of being opportunistic sellers, but we go into pretty much every deal, especially multifamily deal we would do, with the intention of executing on this long-term hold, infinite return strategy. So I think for folks that are going to be around us and are interested in looking at our deals, I think this is a critical component to understand and know sort of how we look at how we underwrite deals. Good deal. Adam, anything else on your end?
Appreciate everyone being here.
Absolutely. Yeah, everybody, thanks for being here. We'll look forward to seeing you on the next one. Just remember, where freedom leads, real wealth follows. Thanks, y'all.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.